President, Mr. Jain, Ganesh Purohit sir, all other participants on the Zoom meeting. Good evening to all. Now, this is the last Zoom meeting of the year 2024 and of the present committee. Now, the new committee will take over from 1st of January. So, now today's topic is the tax implications of the real estate development contracts. And our speaker today is Mr. Sushil Pansukha, and he's a very leading person, has a long experience of more than 20 years, 40 years as a chartered accountant. He has been practicing, has been advisor to many corporates and big assessees, and he has been also the member of ITAT. He has been the president of Association of Corporate Advisors. He is also presently the member of Direct Tax Committee of the Institute of Chartered Accountants of India. So he is well recognized in the subject, and he has full command on the income tax topics, important issues. So this is why we have requested him to take up this very important topic. As we all know, real estate development contracts is a very important issue, and there are many issues, complications as far as these real estate development contracts are concerned. And main issues are whether at what stage there is a transfer that raises an issue, whether is it chargeable as a capital gain or as a business income, and many other issues are there. I am not going into detail in all these things. So we'll request Mr. Sushil ji to take up the topic. Before he takes up, I'll request our president, Mr. Narayan Jain, to give his opening comments, and then we'll request Sushil ji to take over.
Thank you, Chairman of the committee, Shri V.P. Gupta ji, the most outstanding man of AIFTP for the year 2024, and our learned speaker, Sushil Bhai Pransukha ji. Friends, before I speak anything about today, it takes me to yesterday evening when we got the news that Dr. Manmohan Singh is no more. I had affinity towards Dr. Manmohan Singh ji because when he was the Honorable Finance Minister in the year 91, he was kind enough to release my book in Calcutta. At that time, reforms and opening the economy, globalization, lot many things were going on. So despite lot of odds and difficulties, he served not only as Finance Minister, but also Honorable Prime Minister for 10 years. So on behalf of the Federation, we pay our homage to the memory of Dr. Manmohan Singh. And today, this subject, those who are suffering because of the property development, our Sushil Pransukha ji, our learned speaker, will be throwing light and also analyzing section 45(5)(a) as to what relief it has brought, and to come out of the clutches of taxing such transaction. He will also give us some tips which will be useful. So we will carefully listen to him. And though Gupta ji is saying that today is the last webinar of this committee, but I don't know between this 28, 29, 30, 31, 4 days what he can do, because he is very dynamic. So friends, our Secretary General is also joined from Hyderabad. Indubai Chatrat has joined from Goa. And there are persons from Kerala and other places. So we will not spend time on any other thing, but we would like to listen to our learned speaker, Sushil Pransukha ji. Gupta ji, back to you.
Welcome, Sushil Pransukha ji. Please take over. Please take over.
Thank you. Respected Jain ji, President of the AIFT, V.P. Gupta ji, and other important dignitaries of the AIFT. And I am very fortunate enough that I have at least got the chance to speak on this platform on India basis on the last webinar of the year. And I am fortunate enough also because I have been attending almost all the webinars of this year, because Jain ji has been so delicate and so meticulously planned the webinars. All the topics were very good, and I hope that new team will also continue the same thing. And today's subject has also been taken very contemporary subject of real estate taxation. Friends, we all know that real estate itself is a very, very backbone of the economy of the country. And nowadays we see that everywhere is a real estate boom. And real estate transactions are very much complicated by nature itself. When there is no specific provision in the Income Tax Act, how to deal with the taxation provisions of real estate from the point of the landowner or from the point of the developer, how should we recognize the revenue and what will be the point of taxation? There is no specific provisions of the to dealing with the joint development agreement, which is in itself nothing but a only commercial contract between the landowner and the joint development developer, who enters into the different terms and conditions to develop the land, which is on the provided by landowner to the developer to construct, erect buildings for commercial purposes or residential purposes. Friends, I will deal these aspects from the both aspects, from the landowner aspects and from the real estate developer aspects also. From the landowner aspect, let me share my screen. There are two types of contract between landowner and the developer. One is area sharing and another is revenue sharing. In area sharing, landowner agrees to give land to developer to develop the property, and in consideration of that land, receives some area. Suppose 10,000 square feet area of land belonging to the landowner, he gives developer to develop it, and in consideration he receives 4,000 square feet super built up area. This is the area sharing agreement. And in addition to the area sharing, he can also receive some cash. And landowner can be company, LLP, individual, HUF, can anybody. And similarly, developer can be any entity. Other agreement is revenue sharing, where landowner enter into a joint venture type of agreement with the joint owner and shares on the revenue. He does not take any area into it. They jointly develop the property. If terms and conditions so provide, then they share the revenue as agreed between them. So let us, first I will deal landowner area sharing or revenue sharing when landowner holds land as capital asset. Because it may be possible that land is owned by the landowner as a capital asset or a stock in trade. So first of all, I will deal with when area landowner is having the land as a capital asset. These are the commercial terms I will deal later, because I have to give some, as per the theme of today's webinar, we have to give some terms and conditions also, how should we draft the joint development agreement. Friends, while on the subject capital gain on the land as a capital asset by the landowner, Section 45(1) is the governing section. Until subsection 5A came in, there was no specific provision. This section itself used to govern all the joint development agreement also. And this is the basic sections under which capital gain is charged. This section says that any profit and gains arising from transfer of capital asset affected in the previous year shall, save as otherwise provided in section so and so, be chargeable to tax under the head capital gains and shall be deemed to be the income of the previous year in which the transfer took place. These are the only 4-5 lines, and all other subsections are ancillary to this main section. Friends, words to be marked here is that shall be chargeable to income tax under the head capital gains, shall be deemed to be the income of the previous year in which the transfer took place. This is a deeming provision, and capital gain will be charged in the previous year in which the transfer took place. So there are two conditions here. First off, that transaction should itself be a transfer, and we have to determine in which year transfer has taken place. Then we have come to the conclusion, then in which year it will be chargeable to tax. So in case of joint development agreement, we have to see what is the definition of transfer in case of 247. Transfer is defined under inclusive definition 247, which is Roman 5. It says that any transaction involving the allowing of the possession of immovable property to be taken or retained in part performance of the contract of the nature referred to in section 53A of the Transfer Property Act. This subsection 2.5 is very important from the point of view of the joint development agreement. Joint development agreement, because landowner parts the land, gives the possession to the developer for performance of his part, and in turn he takes some consideration in cash, and developer has to perform his own functions. So this is part performance of the contract, and that has been defined under section 53 of the Transfer of Property Act. So it has the definition of transfer property from the 53A has to be taken. In turn, 53A of Transfer of Property Act says that when the buyer and seller agrees for a part performance and buyer is willing to perform his part of the contract, then it is a part, this is the transfer of property, and it can be regarded as a transfer. So if this transaction, any transaction of joint development property is in position is given, and that fits into the definition of 53A of the transfer of property, then it can be called as a transfer, whether that property, that agreement is registered or not. So far this definition is concerned. But there was amendment in Transfer of Registration Act, Transfer of Property Act, that this agreement, if it is not registered, joint development agreement is not registered, part performance agreement is not registered, then it has no effect in law. So this assumed importance because of the decisions of the Balbir Singh Maini, which I will discuss detail in later part. So first, friends, this is the section under which joint development property is made taxable after giving the position to the developer. Friends, now several questions arises. Then clause 6 is also important. When I will discuss with the Balbir Singh Maini, I will discuss this. This is very, very important aspect. 47 Roman 6 also. So as I said, that we have to see whether that is transfer or not. For seeing that it is transfer or not, we have read this 247.5. Then we have to see in which year there is a transfer. To determine that year of transfer, there is no mention in the act that how the year of transfer will be determined. So that there are several jurisprudence are available how in which year transfer has to be determined. In that year only capital gain will be charged. They are conflicting decisions. But I will discuss what Chaturbhaj Dwarka Prasad 260 ITR 491. This is the initial discussion, and this decision has laid down a very landmark judgment in the joint development agreement. This agreement says that it has to be seen when the effective control has been given to the buyer. And when it is found that effective control has been given to the buyer, so that buyer can use his property at his own will, then it can be said that transfer of property has taken place. So at the date of signing of the joint development agreement itself, it can be a transfer if effective control of the land has been given to the joint developer. So passing of this is the ratio of the Chaturbhaj Dwarka Prasad. Many of us may be understanding this judgment, that this segment has been diluted after so many judgments. But friends, all the judgments because the taxation of joint development agreement is factual base. only facts are relevant for adjudication of any. So all judgments are relevant on their own facts. So ratio of Chaturvas Dwarka Prasad, that there should be passing of complete control, it still rules the roost. It is still valid. Like this, there are many judgments that when there is a complete transfer of control or ownership, then itself. So those things has to be determined from the terms and conditions of the joint development agreement, which is a commercial contract. From the joint development agreement, it should emerge that when the complete control has transferred to the buyer. So definition of the 247, as we have read, it can be interpreted that when the right of ownership is transferred in the manner that a buyer can use, enjoy, dispose the property at his own discretion, transfer of said can be said to have taken place. Principle of substance over form shall apply. As a substance, that should be transfer control. It can be of any form, maybe power of attorney, maybe is agreement of sale, but that document, if justifies that there is a complete transfer of control, transfer of ownership, so that developer can use the property at his own will, then it will be a transfer. In that year only, it will be a transfer. It may execute an agreement for sale or power of attorney, transfer of complete control is significant criteria. There are other factors also. Date of entering the joint development agreement and executing PO. The date on which the joint development agreement is signed and power of attorney executed, that day can also be, that year should also be year of the transfer, but not necessary. Terms of contract shall decide in which year of transfer will take place. Handing over the position to developer for development. Whether handing over the position to developer is itself year of transfer, not enough. Because sometimes, as per terms of the contract, permissive position is given. Only position is given as a licensee. So in that case, position given is not the transfer. The receipt, part sale concession from the developer. The question arises whether if landowner receives the sale consideration from the developer, whether it will transfer. Date of execution of the power of attorney in case of developer authorizing him for sale of developed units, it is of discretion whether that date will be transferred. So transfer of developed units to the customers, not necessary. It is also not necessary. So any single criteria does not give rise to transfer. Cumulative effect has to be seen whether unfettered right has been devolved on the developer or not. And this last point number 6, at the time of getting the constructed area of his share, when the defect, naturally when the area sharing agreement, I will get my area share. Suppose out of 100 flats, 25 flats I will be getting. Whenever this allocation agreement is done, my area is allocated. At that date also, that can be a date when the transfer of my land has taken effect. So, in case of area sharing, there are two parts. How the capital gain will be computed based on the above factors. Getting consideration of his share of constructed area, stamp value of constructed area, cost of the superstructure. Friends, there is one part is that when eventually I get my construction area share, that date can be transferred. That date can be assumed. So generally, practically, this happens that when allocation is done between the developer and the landowner, that date when share of land owner of constructed area is given, then on that date transfer, capital gain is computed. And how? A stamp value of the constructed area. How the stamp value of constructed area can be had? Stamp value of whole flats can be taken, and out of that, a stamp value of the land can be deducted. So we can get the stamp value of the constructed area or cost of superstructure, whichever is higher, because a stamp value has to be taken. Otherwise, 50C will be applicable. Friends, if 50C, if consideration is not determinate, then in case of the taking position of the constructed area, 50D will come into play, where consideration is not considered not determinate, 50 days will be a fair market value of that area will be taken as a consideration. Then second part is that suppose I get my area, then I sell it. Then that is separate transaction. Sale of developed units by the landowner, it can be long term or short term. Suppose landowner can keep some flats for some long term or short term, or he can immediately sell it. That is separate transactions. So transfer of land from the landowner has two aspects: getting of the constructed area and sell in to the ultimate purchasers. Friends, I stated that no specific section for joint development till section 5A inserted assessment 89. As we have discussed that lot of complexities are there in determining the year of transfer. So to avoid this, to overcome this difficulty, at least for individual and HUF, for individual HUF, this subsection has been brought in from assessment 1819. Subsection 5 says that notwithstanding anything contained in subsection 1, it starts with a non-obstant clause, notwithstanding anything contained in subsection 1. So what we have read in 45.1, that governing section, that is ruled out, and only we have to concentrate on this for the individual HUF. Where the capital gain arises to an assessee being an individual HUF, from the transfer of capital asset being land or building or both under a specified agreement, the capital gains shall be chargeable to tax in the income the previous year in which the certificate of completion for whole or part of the project is issued by the competent authority. And for this purpose, section 48, stamp duty value on the date of issue of the said certificate of his share, being land or building or both, in project as increased by the consideration received in cash, if any, shall be deemed to be the full value of consideration received or accruing as a result of the transfer of the capital asset. Then there is a proviso. I will come to the proviso later on. I will dissect this 5A. This 5A say that if it is an individual HUF and if there is a specified agreement has been defined below as a registered agreement between landowner and the developer as area sharing. So this 5A applies to only area sharing, not to revenue sharing. So in that case, there are two situations that if landowner gets constructed area before completion also, but his taxability is postponed to the year of completion certificate. So whatever 45.1 says that in the previous year in which transfer took place, capital gain will be chargeable. But 5.1 section 5A overrides section 45A, 45.1 to the extent that it substitutes the year of transfer to the year of the completion of the certificate, issue of completion certificate. So one thing is clear that year of transfer in this case will be issue of the completion certificate in which capital gain will be computed and offered to tax. And what will the consideration? Landowner's share of his share. His share has very double meaning here, because before this subsection came, friends, we know that we used to compute capital gains for the capital gain landowner perspective in the manner that whatever constructed area landowner gets, so landowner does not alien his own share. His share remains of the land, he remains with him. Whatever is getting of the superstructure only. But this subsection now says that total area will be seen as a having given to a developer. Then again, land and building in the flats will be taken by the landowner. So why this has been done by the legislator, I don't know. But this is the interpretation coming out from this, that in the year of completion certificate, entire land has to be taken as a cost of deduction by the landowner, and entire value of the flat, including land, again, even if land is with him, we have to take this thing. We have to determine the capital gain tax in the year of the completion certificate. Here, one more question issue arises, that this section says that stamp duty value in the date of the said certificate. Here says only stamp duty value on the date of the said certificate. Suppose fair value of the flats which have been received by the landowner is more than this, then whether for fair value substituted, because there is a specific clause here only. And if fair value is below than this, then of course a stamp value will be taken here. A stamp value will be taken on the date of the said certificate. Then one more issue comes here, that indexation will be available on which date, because here there are two views, friends. That one school of thought says that transfer has already taken place when the effective date of execution of the joint development agreement. Transfer has already taken place of the land, and this year only chargeability has to be postponed to the year in which the completion certificate is received. To my understanding, this is not correct view, because this subsection starts with the notwithstanding anything contained subsection 1. So we should not read at all the subsection 1, 45 section 1 for the purpose of completion certificate individual HUF. And so indexation will be available till the year of the completion certificate. And because it is settled law that only practical interpretation has to be given any provisions of the Act, this should give workable solution. Because if we take consideration of this year and cost of previous year, then it is not workable. Provided that provisions of this subsection shall not apply where assessee transfers his share in the project on before the date. Then there is a proviso, there is exception to the main proviso, that before completion, if the landowner sells his share, then its section says, then this benefit of this postponement, deferment of tax liability is not available with the landowner, then in which the transfer has taken place before the date of certificate of completion, then in that day will be treated as a date of transfer, and all the provisions of the previous 45(1) shall apply, as we usually do. So in case of assessees, other than the individual HUF, companies, LLP and all that, all these disputes, all these issues still remains, that in which year the year of transfer will be. So these are the definitions I have already dealt with. This thing I also dealt with, date of completion certificate. If date of completion certificate, if part completion certificate is also received, then also in that year capital gain will be chargeable. If landowner transfer the land in unequal manner by executing conveyance deed before CC is received, अगर CC मिलने के पहले ही उसको मिल गया, conveyance deed हो गया और ट्रांसफर हो गया, तो भी उसको CC में ही on the date of CC capital gain will be charged. This is benefit to the landowner for deferment of tax liability. There may be a situation that when land is transferred at later date than date of the completion certificate. If land had been transferred on later date, then completion on the date of completion certificate, capital gain will be charged. Period of holding I have discussed. 48 I have discussed. Income to year received. So next part is that parity with indexation, for indexation, to justify my understanding, when 45(2) we go, when asset is converted into stock trade, that is liable for taxation in the year it is sold. In that case, we take indexation of that year. So on that analogy, we should take indexation in this year also, in the date of the year of the completion. Then friends, up to here we have discussed the area sharing agreement, but most important part is that Balbir Singh Maini and Siasi Steel, I will discuss. These are the main. I have not discussed so many. There are hundreds of decisions are there. Only I have chosen to discuss these two decisions, which I said at the beginning that I will discuss Balbir Singh Maini in detail, so that we can very well understand that at which point of time Section 53A Transfer Property Act or Section 45 definition of 247(5) of transfer part position will apply. Friends, Balbir Singh Maini, in facts were different. Balbir Singh Maini had, in the Balbir Singh Maini, SSC had 3 parcels of the land, and in which 3 installments had to be paid and position had to be taken. So there were 3 contracts. In 2 installments, there was no issue because position had been given, money has been received, no issue. Only in the 3rd parcel there was issue that because of Punjab High Court decision that joint development agreement could not take place and joint development agreement had to be cancelled and nothing was received by the landowner. In that perspective, Supreme Court held that since nothing has been received, friends, 45(5)(1) is a deeming provision. So it does not talk about how the consideration will be received, when to consideration received. Even if consideration is not received, then capital gain is accrued in that year in which transfer took place. But Balbir Singh Maini take a deviation from there that it introduced a concept of real income in the Balbir Singh Maini, that if money has not been received, capital gain has not accrued. Friends, what I was talking that this 3rd parcel of the land, in that perspective, Supreme Court held that since there is amendment in the Transfer of Property Act, that it should be registered, 53A agreement should be registered, otherwise it shall not have the effect. Supreme Court taking clue from there held that if that registered agreement is not there, then it has no lawful transaction and there is no transfer, there is no capital gain. In that perspective, friends. But there was a gap here. That gap has been fulfilled by the Supreme Court in CRC Steel. CRC Steel is a very good judgment in discussing the 53A of the Transfer Property Act, friends. It fills the void that position is a legal concept. Unless there is a legal position has been given to the developer, there can be no transfer. Merely because position has been given, a license has been given, permissive position has been given, that position itself does not per se is a transfer. It is only a legal position when it is legally entitled to transfer. Then only it can be the CRC Steel. So it makes what it makes by reading 2 judgments together, that even if the joint development agreement is registered, it may not result into transfer as per 247(5), Roman 5. But even if it is not registered, it can have the legal repercussions, it can be treated as a transfer. So friends, I said in the beginning that there is a 247(6) also, Roman 6 also. So I am going back to 247(6). I am reading 247(6). This is very important because that was also discussed in Balbir Singh Maini. Any transaction, whether way of becoming member or acquiring share in corporate society, company or other association of persons, or by agreement or any other manner whatsoever, which has the effect of transferring or enabling the enjoyment of the intangible property. This says that any arrangement, any agreement which has the effect of transferring or enabling the enjoyment of the property. If any immovable property is transferred for the enjoyment and buyer is enjoying the property, that is also transfer. This subsection 6 does not say about the registration aspect. And this has also been discussed in Balbir Singh Maini. Very interestingly, in Balbir Singh Maini, when revenue lost the hope, it took the plea that at least give us the chance under 247 Roman 6, because we have given the position and for the enjoyment of the property. That then Supreme Court had a clear finding that this subsection 6 is for the purported ownership. If all the attributes of ownership has been transferred, whether that is registered or not, then it is a transfer. But in the case of Balbir Singh, since there was a finding that is a limited purpose land has been given for development, so there is no ownership right has been given to the developer, so this section also does not help. So in reverse, what it means? It means that if there is a purported ownership transfer. Nowadays, we all see in practical life. Then we take the landed property, we buy the flats and get registration after 5 years, 6 years. Whether now there is common understanding in the professional circles that in the registration year it will be taxable as the capital gain. My humble understanding, this is not possible because of we can take the help of 246, 247 Roman 6 that once I have taken the possession of the flat, I am enjoying the property, I am as a purported owner. Whether registered is only method of conveying the property. So friends, this Balbir Singh Maini as CRC Steel had gave us the clear understanding that when the year of transfer will be there. So this was the revenue sharing, this was the area sharing part. Now, revenue sharing. In revenue sharing, what happens that, as I said earlier, that both parties come together for sharing of the revenue. Main conditions may be that owner and builder agree to develop the immovable property for residential commercial use. Owner and builder, developer agree to share the revenue as a ratio earlier decided. Various terms for sharing of the revenue such as gross revenue, distributive revenue, pass through charges, etc. will be detailed in the agreement. Agreement will be styled keeping in dual ownership concept in mind. This is very important in revenue sharing. Owner will transfer undivided right title, interest in land, and developer will transfer super built-up area in favor of the ultimate purchasers of the apartment. Nature of consideration to be received, modality of sharing revenue, everything has to be mentioned in the revenue sharing agreement. Clause on data commencement, date of commencement, date of completion, grace period to be given to the developer, compensation to the owner, delay subject to conditions, force majeure, etc. to be included. Compensation from the private prospective buyers to be charged by both the owner and developer for delay in receipt of the installments to be standardized. Agreement on pricing, that is periodical fixation of minimum price to be adopted for sale for a specified period. Developer to be responsible for all the matters relating to construction, including adherence to the applicable laws, specifications to be provided, quality of the construction, etc. General power of attorney will be given to developer for entire area to enter into the agreements and sell divided interest in land, and developer transfer super built-up area in favor of the ultimate purchase of the apartments. So what is the difference between area sharing and revenue sharing? There is some advantage here because while area sharing is quite complicated in nature, there are a lot of complexities because we take the area and say when will be the transfer, when will be this. But in that manner, area revenue sharing very simple. When risk and reward is transferred, it is taxable in that year, and stamp duty value of that year is taken. So it is advantageous in the form of that postponement tax for landowner. And landowner can postpone the tax because in area sharing there is a chance, there is a high chance of litigation that department may initiate the legal proceeding against the landowner that why not tax has been paid, capital gain tax has been paid in the where joint agreement date has been agreed. We see day and night there are a lot of litigations there. And in case in this revenue sharing, there is no chance of 50D on entering on the JDA. On the date of JDA, because there is no revenue recognition on that day, there is no chance of 50D. This is the advantage. But at the same time, there is some disadvantages also. Owners cannot hold on to their stock and have the benefit of increase in sale price. Since this is the revenue sharing agreement, both will sign as a owner, landowner or developer. So owner cannot hold their stock. They have the benefit of increase in sale price. They cannot take the benefit of sale price. No recourse available to the owner if developer delays completion, except invoking a specific performance and claiming compensation. Developers could have an issue if owners have not paid his tax on his revenue share and department takes coercive steps to recover tax dues by touching the unsold apartments. These are the disadvantages. Owner could also be deemed to have entered into activity which could be construed as a nature advantage in the nature of trade. This is very important. Suppose owner is having the land as a capital asset, but suppose he enters into a revenue sharing agreement, there is a high chance that it can be treated as an advantage in the nature of
तो
trade.
मैं निकाल के दूं, मैं निकाल के दूं, मैं निकाल के दूं।
नहीं मैं निकाल दूंगा सर, मुझे तो टाइम दो सर प्लीज।
तो मैं तो ऑलरेडी बहुत टाइम दे चुका हूँ भाई।
सर मैं जो टाइम दे तो काम हो गया है, मैं ताकि शाइन पारी की बात कर रहा हूँ।
नहीं
रवि सबको
साकेत और
म्यूट
शहन
कर दो।
परीख के
रवि
छोड़
यार
के बाकी आरपीएस प्रीति सबके हो गए लेटर्स पूरे।
स्पीकर के अलावा
हाँ,
सबको म्यूट
उसका
कर दो।
उसका पेपर्स किधर है सब लेटर्स के, उसके पास लेके जाने अपने को।
आरपीएस का सबमिट कर दिया तुमने बैंड्रा में अपना।
प्रीति का
हाँ
प्रीति का
बात क्या, अलकेश भाई से कल तक देने वाले हैं।
सर
क्या
प्लीज
देने
म्यूट
वाले हैं?
योरसेल्फ।
Mr. Ashish Shah, please unmute. Please mute yourself.
एक मिनट
Mr. Ashish Shah, please mute yourself.
प्रीति तिरुपति का सब कृष्णा ने भेज
You are disturbing the webinar.
किया है कल शाम को।
Mr. Ashish Shah,
नहीं तो
Mr.
क्या
Anish
क्या
Shah,
एक मिनट, अलकेश के पास से क्या चाहिए तुमको?
मैं बात कर लिया
Mr.
है।
Anish Shah,
तो
please
बात कर
mute
लिया है।
yourself.
क्या बात कर लिया है?
सर वो लेटर जो दिया है उनको प्रिंट आउट मांगा है साइन होके, तो
हाँ।
वो देंगे मुझे।
नहीं तो उसको बोलो आज रात को घर पे भेज देंगे मेरे।
हाँ ठीक है, बोलो।
Friends, this clause D is very important. Owner, if he having the capital asset, land as a capital asset, then since he has entered into the revenue sharing agreement, it can be said that he is involving in the business activity jointly with the developer. So it can be treated as a business income instead of the capital gain. Department could also take consideration that it is AOP. GST on transfer of development rights by landowner will also apply in this case. Friends, if landowner holds as a stock in trade, then it is a business income, which I have already discussed. In revenue sharing, different thing, but it was revenue sharing was when he was holding the land as a capital asset. But if he itself holds the land as stock in trade, then its income will be as a business income. And in that aspect, AS9 and ISDS 4 will apply. So when we'll discuss the institute guideline, we'll discuss again this thing. So friends, so far I have discussed the tax implication of the landowner as a capital asset or a stock in trade on the basis of revenue sharing or the area sharing. Now, one of the most important factor which is quite challenging for the contractor, for the developer. So as a real estate or a real estate developer, there is no specific section in the Income Tax Act. So accounting standard AS7, AS9, and there is a guidance note by the Institute of Chartered Accountants of India issued in 2012. Earlier it was 2006, it has been revised in 2012. Guidance note quite ably prescribes and mandates that how the accounting should be done for the real estate developers. Friends, since there is no income tax provision that how the income tax should be offered by the developer, so only this guidance note help how to compute how to make the accounting of the income tax. So the income tax computed as per the guidance note only is relevant, and lot of their judicial decisions I have not mentioned here. Lot of decisions are there who have leaned in favor of the institute guidelines for taking clue that how the income tax should be charged on the real estate developers. Guidance note is mandatory for business entities or business because it is involved in the business activity. As a professionals, as chartered accountants, we render our professional duties. So we have to take note of the guidance note because we have to certify the accounts. So we have to mention that the guidance note has been followed or not. Friends, as per this guidance note, infrastructure projects are not covered because generally infrastructure projects are held as an investment.
उसमें जो साई का टर्नओवर महीने में 50 लाख है और
so this guidance note applies only to the business activity because developer involves in the business activity. If any investment is created as an investment, as a fixed assets, then accounting standard AS10 shall apply. Whether the activities of the real estate have the economic substance. First and foremost thing, guidance note gives the guidance that which way the accounting should be done, whether as a sale of goods or as a contractor. So it has to be deciphered from the only terms of the contract. Guidance note says that economic substance has to be determined, whether real estate activities by the developer in case of economic substance of the real estate activity is similar to the delivery of goods. If by reading the contract, we come to the conclusion that real estate activity is similar to delivery of goods, principle enunciated in AS9 or revenue regulations are applied. We will deal later. In case of economic substance is similar to construction contracts, AS should be applied. AS7 should be applied, which talks about the percentage completion method. So if it is AS9, then we have to see when the risk and reward has been transferred. And at that point of time, revenue has to be applied. When is a construction contract, then we have to see that at what point of time we should start this charging to revenue at by charging this percentage completion method. Revenue recognition of as per AS9 says that when it happens, seller of goods has transferred to the buyer the property in goods for all the significant risk and reward of ownership have been transferred, and seller retains no effective control on the goods. When property in the goods have been transferred and all risk and reward has been ownership has been transferred, the seller retains no effective control, and there is no significant uncertainty exists regarding amount of consideration. Then it can be said that significant parts has been transferred, and at that point of time, the revenue will be recognized. Now, friends, whether significant risk and reward transfer or not, examination of the sale agreement and other documents requires careful analysis. So, as I said, that this main edifice of whole the discussion is that this joint development agreement that has to be very carefully examined, that whether risk and reward has been transferred or not. When at what point of time risk and reward has been transferred. Only economic substance is not determinant of, it is not determinant of the legal form, whether it is a power of attorney or sale agreement or conveyance. But if it is a substance, in substance it is contractor, then we have to follow the AS7, otherwise we have to follow the AS9. So principle of substance over form applies. From the terms and conditions to be determined whether significant risk and reward at the execution of sale agreement or the time of the possession. Or so from the terms and conditions, we have to see when significant risk and reward at what point of time has been transferred. At the time of the sale agreement or the time of the possession or registration. किस समय में हमारा execution हमारा transfer हुआ, risk and reward transfer हुआ. In case terms condition suggest that risk and reward not transferred at the time of sale agreement, but are transferred at the time of the transfer of ownership or possession, it may so happen that at the time of execution of the joint development agreement, risk and reward is not transferred. But at the time of the ownership of the possession, at the time of the signing of the conveyance deed or possession given, then it is in the nature of the delivery of goods and revenue to be recognized at that point of time. So this A and B is very important. It says that if risk and reward is not transferred at the date of the signing of the joint development agreement, but it is at the time of transfer of ownership or possession of the real estate, transfers would be in the nature of delivery of goods and revenue to be recognized at that point of time as per AS9. So guidance note has taken help from both AS9 and AS7. It is mixture of guidance note, a mixture of AS7 and AS9. Once it is determined that real estate developer had transferred all the risk and reward to the buyer at the time of the execution of the binding sale agreement. At the time of the execution of the binding sale agreement, which is enforceable in law, any acts on the real estate performed by the seller developer are in the substance performed on behalf of the buyer in a manner similar to the contractor. Point B says, guidance note says that if there is a binding sale agreement with the developer, with the ultimate purchaser by the developer, then any acts on the real estate, construction and all that, he does those acts on behalf of the buyer. So it becomes the contractor. So this nature becomes the contractor, and a 7% of completion method has to be applied. So there are only two situations. There are other parameters also to determine when risk and reward can be considered as a transfer. Risk and reward, when transferred, it can be considered by different parameters. Whether entering into binding sale agreement, risk and reward of the increase or the decrease in the price is transferred to the buyer. Whether buyer acquires the authority to transfer the property to third person, even before getting the possession title of the property. This second part is very important, friends. In day and night, we see in the joint development agreement that buyer acquires the authority to transfer the property. Even before he takes a position, he can sell to other third person, even without with the taking the permission from the developer or the landowner. So in that case, if this is the case, then percentage of completion method has to be applied, because buyer gets the independent right. He can sell the property also, he can exit. So at the it can be very well said that at the time of the execution of the sale agreement itself, property has transferred, and buyer developer only acts as a contractor. The guidance note AS9 says that completion, how the revenue recognition process is usually identified when the following conditions are satisfied. Seller has transferred. These are the factors upon which we can say the revenue recognition process has started, identified. The seller has transferred to the buyer all significant risks and rewards of ownership, and the seller retains an effective control of the real estate to a degree usually associated with the ownership. It says that seller has transferred all the significant risk and reward ownership, and seller retains no effective control of the real estate to a degree associated with the ownership. So all the privileges of the ownership has been transferred. The seller effectively handed over the possession. No significant uncertainty exists about the consideration and the collection. These are the 4 points which gives an idea that whether at what point of time revenue recognition should be done and whether this is significant risk and reward transfer or not. In the similar manner, application of percentage completion method. There are several factors to determine from the agreement itself. The duration of such project is beyond 12 months, and the project commencement date and project completion date fall into different accounting periods. Naturally, when these are the contracts, real estate projects span over more than 12 months, 3 years, 4 years. So this condition is fulfilled. Most features of the projects are common to construction contracts, that is land development, structural engineering, architecture, design, construction, etc. While individual units of the project are contracted to be delivered to different buyers, they are independent upon or integrated to the completion of number of common activities. So if there is a product of so many flats, so many units, and there is a common interrelated completion of the common facilities, then also this is a part performance contract. Construction of the development activities form a significant proportion of the project activity. So this method is applied when the outcome of the real estate can be estimated reliably. So friends, this I have discussed the ICAI guidance note for accounting purpose, which is also very, very relevant for income tax purpose for the real estate developer perspective. After this, initially I was going to discuss then how should we draft our agreement so that there is no dispute later on regarding the taxability of the capital gain. In case of area sharing, commercial terms should be like that. Owner and developer builder agree to share the area development ratio as agreed upon. Allocation agreement and post-plan sanction. Owner of the land and agree to share the developed area. Gender power of paternity executed. Power to mortgage to developer share. These are the clauses remain in the joint development agreement. Owner to deposit title deeds with the financial institutions. The financial institution will give a letter of endorsement stating that owner's share of interest is not secured or charged. Clause on date of commencement, date of completion, grace period to be given to the developer, compensation to the owners for delay in project, to conditions, force measure to be included. Area, sharing, allocation agreement to be entered into immediately after plan sanction. This is very important. Roman 7. The developer builder is granted right to enter the immovable property as a licensee, as understood under Section 52 of the Indian Easement Act. I will also show you the one model joint development agreement. What is the exact should be the clause? To commence the construction activity, it is specifically stated that legal title, domain, get control of the property continues to be vested with the owner. So this clause must be there to avoid the tax in the year of the entering into the joint development agreement, because it says that ownership of the property continues to vested with owner in its transfer in the favor of the ultimate purchase of the apartments. So agreements on price parity, review of the minimum price to be fixed periodically to be provided in the agreement. Developer to be responsible for all matters related to construction, including adherence to the applicable laws. For this, all this developer responsibility. RERA requirement also has to be seen. Power to the developer to enter into agreements or collect advances. This is the power given in the agreement, that agreement for sale can be entered with the ultimate purchasers and advances can be received. RERA and GST clauses to be elaborated. Now I will see you the model. Page number 29. Space allocation. It is hereby agreed and declared. आप लोग पढ़ पा रहे हैं क्या इसको? हेलो हेलो,
हम लोगों को दिखाई नहीं दे रहा है।
स्क्रीन पर विजिबल नहीं है जी कुछ भी।
इसकी विजुअल कुछ भी नहीं है, मतलब ये नहीं है। और पहले वाला था
नहीं, कोई बात नहीं, कोई बात नहीं, प्लीज गो अहेड।
नहीं, पहले वाला तो विजिबल था ना?
नहीं, कुछ नहीं था,
कुछ भी नहीं दिखाई दिया।
अच्छा,
कोई बात नहीं, कोई बात नहीं, यू हैव एक्सप्लेन्ड।
तो मैं पढ़ के सुनाता हूँ। It is hereby agreed and declared by and between the parties hereto that in consideration of the above, owners shall be entitled to all that the 62.5% of the total constructed area to comprise in the various flats, units, apartments, constructed spaces, car parking spaces, including any open spaces, and terrace area, form an integral part of any flat, and together with undivided proportionate share in all common parts, portions, areas, facilities, amenities, and car parking spaces in the housing complex, and together with the undivided proportionate area of land underneath the whole building, apartment, and the area I want to show you. This is 29 page number 38. This is a most important clause. The landowners have granted a limited power of the developer to enter upon the said premises as licensee only for enabling them to develop the said premises in accordance with the plan. It is hereby expressly agreed by and between the parties hereto that possession of the said premises is not being given or intended to be given to the developer in part performance as contemplated by Section 53A of the Transfer Property Act. Read with, ये एग्रीमेंट में लिख दे रहे हैं कि 53 of transfer apply नहीं होगा इसमें. With the section 247(5) of the Income Tax Act, and that the owners and developer hereby confirm that by virtue of the developer entering upon the premises as a licensee, same does not amount to taking of the possession to said premises. It is hereby agreed and declared that jurisdictional possession of the said premises shall always vest in the owners until such time the development is completed in all regards. So this paragraph must be there. It clearly says that ownership will vest in the owners until such department is completed in all regards. So draft of the area agreement I have shared. ये आया क्यों नहीं, मेरे को समझ में नहीं आ रहा ये.
कोई बात नहीं सर, प्लीज कंटिन्यू.
अब आ रहा है क्या? अब
नहीं नहीं, स्क्रीन पर नहीं आ रहा है. स्क्रीन शेयरिंग शायद आपने करने से रह गए हैं, बट डजंट मैटर. कोई बात नहीं, कोई बात नहीं. आपने पढ़ दिया, ठीक है, ऑलराइट.
अच्छा, रेवेन्यू शेयरिंग मॉडल की क्या क्या ऑब्लिगेशंस ऑफ द ओनर्स के हैं, ये तो इतना पढ़ना मुश्किल है. तो मैं ये पीपीटी शेयर कर दूंगा तो आप लोग शेयर कर सकते हैं.
ठीक है, ठीक है, जो
इसमें मॉडल एग्रीमेंट दिया हुआ है. Next, one important thing at last I will say that there is two judgments I have said. One is Chaturbhuj Dwarka Prasad, second Balbir Singh Maini, CRC Steel. One important judgment is very, very important judgment of Bangalore Tribunal. Mathi Kare Ramaiya, ITA 542 to 544, in which case landowner holds the land as a capital asset and enters into a revenue sharing agreement. In that case, as I said, revenue attempts to make the capital gain as a business profit in the hands of the landowner. But criminal trade had very deliberately, very good order. One must read in that very clearly replying the AS9, AS7, everything has said that if he is holding the asset as a capital asset, then consideration, how consideration is coming, not coming, it doesn't matter. It should be capital gain only in the hands of the landowner. So friends, I have completed this thing before time because very long subject. I wanted to give disclaimer at the beginning that I will not be taking 2 hours because I have kept very short and crisp, very.
सुशील जी.
Yeah.
Hello.
Yes.
Sushil, you have done very well. You have tried to do your best, but the subject is so confusing.
Yeah.
That I don't think that there is so much clarification even now. But the 2-3 issues I will just request you to kindly explain again.
Yeah.
One thing, that the whole agreement, our always attempt has been and should be that capital gain become taxable at the end when the project is completed or transfer takes place after the construction is completed. So to some extent you have tried to say, you have quoted the paragraph which should be drafted and all that, but saying that section 53A will not apply, or this is only for the possession purpose, ownership will remain continue, how far this will protect the assessee or will postpone the chargeability of capital gain to the last moment when the project is completed and handed over to the possession of the part of the property is given to the owner. So can you just throw light how far, because I think the wording of this paragraph, apart from this wording, there have to be certain other things. Once I give the possession, he is under the control, he is doing all that work. So how far do you feel that, how to protect the assessee himself from this situation?
To make these things clear only, I have said that this Balbir Singh Maini and CRC Steel has to be read together. And CRC Steel is very, very landmark decision to deal with this aspect only. CRC Steel says that mere position given to the developer is not transfer. Position, allowing position, it should be a legal, it is a legal concept. That should be legal position. So taking help that we have to fight our case. because department is still charging capital gain tax in the year in which the joint development agreement has been executed. But we have to make our case because on the basis of our joint development agreement, that we have given only the permissible position. He is entering only as a licensee. He is only a contractor. I am transferring the ownership because there is a Supreme Court decision also of the Suraj lamp that ownership can be transferred only through a registered deed. So by taking help from those decisions only we can defend our case.
Because always the dispute is this only. Department says at the first stage, assessee says at the last stage.
Yeah.
So that is the whole issue in regard to joint development agreements.
Yeah, correct.
So the emphasis, how the agreement or what particular clauses or what, because just saying that possession is only for the purpose of this, how far that is the dispute in fact. So can you just throw more light on this aspect?
गुप्ता जी कंस्ट्रक्टिव ओनरशिप को जरा तय करें.
Just a minute.
कंस्ट्रक्टिव ओनरशिप.
नहीं, करेक्ट, वही मतलब है कि डिपार्टमेंट always says that actual possession has been given, constructed. Just saying that agreement is not registered, 53A is not applicable. So will it protect the assessees?
Will my opinion, I don't agree with Sushil ji.
Sushil ji, there is one more point.
Vimal, please let him.
Whether a clause in the agreement can override the law.
No.
Can the applicability of a particular provision can be averted by contract between the parties? That is another question. According to me, if the parties have entered into an agreement and they say 53A will not apply, that does not help because the law will have its own operation. And if the facts you can prove that the 53A is applicable, then in spite of the agreement between the parties, 53A will apply. And department can say that this applies and there is a transfer. Can you please throw some light on this issue?
No, see, these aspects, we have to take only the help from the judicial jurisprudence. And in this regard, especially this jurisprudence is available with the Supreme Court in CRC Steel. CRC Steel facts are similar to what we are discussing today. That when the position has been given, that is not the ultimate transfer factor. That position, apart from this, all the factors have to be seen cumulatively, but only because the position has been given under 53A, it will not be transferred. We have given mere right to develop the property.
It might help to avert the Dwarkadas case, but then I am afraid that 53 operation cannot be avoided.
I said in the beginning, sir, Dwarka Prasad is still relevant. Because in Dwarka Prasad also, it has been said that when effective control is transferred, because facts of Dev's case are different. In that case, on the date of joint development agreement, conveyance has been executed in favor of the developer. So on those lights, decision has been rendered.
Sushil, if there is some clauses inserted to the effect that he will be acting only as a contractor till that stage and only possession is given for construction, and at any stage if the agreement comes to an end, then he has only the rights to receive the consideration for the structure what he has incurred. Can some sort of a clause like this can help?
Sir, that clause only I read just before. That clause only I read. This is very, very good clause that ownership shall vest in the owners until such development is completed in all regards.
Yeah, but because the contractor will be spending so much money in construction, so providing therein that he will have the right only to receive what is incurred or the assessed value for that, can it help in somehow?
No, contractor as a developer, as a contractor and owner will be getting advances. Will be getting, they start selling practically. So
will that not go against? Will that not go against?
No, because terms of sale agreement will say that it will, when ownership will be transferred when the this agreement will flat will be transferred, registered in their name.
In any way, I think this is the moot issue which always comes to controversy and all that. Now, sir, another issue is that 45(5)(a),
Yeah.
as you rightly said, that reading of this goes to say that the whole of the property, whole of the land is to transferred and consideration is to be decided for that.
Yeah.
So if we take that view, that what the section reads, that it says the stamp duty valuation of the share of the landowner,
Yeah.
plus the consideration what he has received by way of check, draft, etc., etc.
Yeah.
So there are two issues are arising herein. First is that what I am not transferring, because I am not transferring the land, what I am having the possession of after that also. Say 50% share is mine, 50% share I am transferring. So what I am transferring is only 50% share in the land, and I am getting against that the 50% structure what the contractor has built in. So I am not transferring. So firstly, the issue is that whether intentionally or unintentionally, I don't know what is the meaning of this, that even the rights which I am holding or continuing to hold is stood being transferred, and I am supposed to pay capital gain on their own also.
It should not be. That's why I tell there are two views, that before 5A came in, what you used to do? Landowner's share of land is not transferred.
Yes.
It remains with us, and we take consideration only as the superstructure.
Yes,
But
that's right.
language
That's
of
right.
this section now is confusing. That it says that whole land has to be transferred, then again taken back.
Okay. So then I am paying capital gain even on that portion.
Yes.
Is
No,
that
but
the
you will
reading of
get,
this, or can we read
you will be getting
some
this
other manner? Is it possible to read this section in a different manner, which I am not transferring? How I am liable to pay tax on that under subsection 1?
Yes, yes, we can. You see, as initially we have discussed, there are a lot of complexities are there, a lot of views are possible. So whatever best view possible according to our understanding, we should do. So we should be prepared for litigation also. So what I want to say that in this case, we can take it like that, that if we have not transferred my share, developer, landowner has not transferred his share, only superstructure consideration is taken and cost of his land is taken.
Sir, another point here, that it talks of stamp duty valuation only for my portion. What is the position regarding other portion, which I am actually transferring? If the consideration received by me is less than the stamp duty valuation, then how this subsection should be read? I'm not clear about that.
No. You see, instead of land, in consideration of land being transferred, what you are
Yes.
getting? You are getting the superstructure.
Right. If the cost of
That's,
that, what I'm receiving is the less than the stamp duty valuation of the land what I'm transferring, then what will be the position?
The problem is that, like 50C, there is no provision here. In 50C, if fair value is less, then we can at least make an application that you refer to DB and all that, but that provision is not here.
But sir, 50C overrides this section also?
50C overrides or not, I cannot say. Because this is a specific 5A is a specific section for individual, and I start with non-obstating clause of 45(1).
What I'm transferring is the land, and I'm getting consideration against that. This talks of deeming consideration as per stamp duty valuation for my share.
Correct.
Then to that, I have to add that consideration. So as a whole, if the property is to transferred, then section 50C says that if the valuation is less than the stamp duty valuation, then that is to be adopted.
So we can take that plea.
But that is going against me. I am talking of the case where stamp duty valuation is more than what I am getting.
No, the stamp duty value has to be taken. If it is benefiting you or not, it is hardly another matter.
Then this language is different.
The language saying that his share means constructed area, what he is getting.
Land language says the stamp duty valuation of my share of land, that is to be added by the cost of what I am receiving actually, by way of check, draft, or any other mode.
Cash.
So constructed value of the constructed portion, check or cash what I'm receiving is to be added to the stamp duty valuation of my share of the land.
Yes.
So it doesn't talk of the stamp duty valuation of the share which I am transferring. That is the confusion.
No, there is no confusion, I think. You have land, you are transferring land, so you have the cost of the land. Instead of transferring of the land, what you are getting, your share in the project.
Yes.
You are getting in the project, suppose 40 flats out of 100 flats. So you have to take the stamp value of 40 flats plus the cash you have received. That is the consideration.
40, what you're saying is 40 flats valuation including land.
That you have to take the chance that whether you want to only
that will go very high. That will go very high. That will be very much high.
So
if I have to take the 40 flats,
go back to the age-old formula that we have to only take the superstructure, not land.
Right. So this section is not giving that sort of a language
properly.
Jain sir, will you like to throw some light on this?
On which?
Yes, sir.
Ji.
It is in the interest of practitioners, advocates, CAs, that such confusion exists. The question is that it requires modification. The provision requires modification, as Gupta ji has rightly pointed out, that the value of superstructure should only be considered. And our learned speaker, Sushil Pransukha ji, may also advise as to, like many places, in Calcutta particularly, he will kindly agree that the landlord, the landowner, is generally getting 10% of the value of the land when he is signing the agreement. And whatever agreements you may be suggesting, but the promoter is compelling the landlord to sign on the dotted line all agreements, including power of attorney.
Hello.
He will never
सर तो बोल दो
agree.
पद्मनाभ चौबे का नाम ले लेगा.
He will never agree to sign. He will never agree that to sign with the landowner that for all practical purposes the ownership remains with the landlord and it will be transferred only at the time of end. But you see, once we deal with any promoter, then like banks are getting signature on their dotted line. Likewise, between the agreement between the landlord and the promoter also has to be in that line. So, Gupta ji, you may kindly suggest as to what amendments in the language should be made. We will do that and we will write to the government, and through newspapers also we will insist. And let us see what is in the store, what comes on 1st of February. But before that also we can write. Like one person, gentleman, has also moved a PIL that the TDS obligations that should be removed. So likewise, we can always keep on writing. So it needs to be fine-tuned.
And Jainji, one thing I will share that on this topic, I have heard Girish Ahoja several times, and he is regularly in touch with the North Block.
Yeah.
And he is saying that he has raised this issue many times with the bureaucrats, but they are not listening.
That is true. They generally listen to the suggestions where more revenue can be generated.
Correct.
Or the leakage of revenue is stopped. You see, they may be expert, Mr. A, B, C, D, G, but then they don't want to listen. That time they took some members into the committee, even the committee of Honorable Justice Eswar Saab. The government implemented some suggestions, whatever suited to the government. And of course, every suggestion which was made by Honorable Justice Eswar Committee was very valid suggestion. But still, we can make this suggestion. Sometime the government may listen to us.
Anyway, Sushilji, you have done very well. Now let us have the questions from the other delegates. Bimal Garg Saab, anything now? Bimal Garg from Dehradun, please.
Sir, you have taken my position already. That is the constructive ownership. How to define
that will be the dispute, in fact.
Yes.
Any other question from anybody? I think there is no issue.
Sir,
Ji.
sir, I have a small question. Suppose in the case of a assessee, if suppose he is not the owner, but he is only the lessee of the property, so he is technically not the owner. But then there are practices in the market that where the lessee has substantial right of the over the property. Then the assessing officer has the power to add it, and he has entered into the joint development agreement. And by virtue of that agreement, the assessing officer has made addition. So such cases, I don't think so we'll be able to take the benefit of Siashi Steels or other judgments as well. And such will amount to transfer under 247(5) or not. No, where the owner of the property is actually the lessee. That is accepted by the assessing officer. So will that help or not?
See, lessee is never the owner. He is only lessee. So sometimes lease agreements are so drafted that he is the purported owner. In that case, because we see there are so many 100 years lease, 19 years lease, in which leases are transferred and stamp duty is paid according to the Ownership and Acquisition Act. So in that case, it will be at par with the that we have discussed.
Sir, but then in case of a lessee also, for the purpose of capital gains, there is no requirement of a person to be the owner of the property. It has to be there are only two things. One is the capital asset should be there, and secondly, there has to be some transfer. So here in that case, the assessing officer can put the point that he is transferring his leasehold rights by virtue of the development agreement, and not maybe the property as a whole, but the rights in the property.
My view is totally different in this case because lot of decisions are there in which it has been said that Section 50C when leasehold rights are not transferable and leasehold rights are not covered under Section 50C. That view will be prevalent here also because when you read the Transfer of Property Act, lease is also transfer.
Correct, indeed.
So if lease is transfer and as per Section 269 AD of the Income Tax Act, immovable property definition is there. Any right in the immovable property is also immovable property. So that question is answered.
So that will amount to capital gains tax, and it
Yeah.
will be transfer under 247(5).
Yes, yes.
So the agreement drafting of the agreement has to be looked into.
Yes.
That's it. Thank you, sir.
Any other question?
So whole joint development taxation is based on the jurisprudence available. Different courts and tribunals what have said, and that ratio has to be applied because there is no specific provision in the Income Tax Act.
May I request R.D. Kagra Sahab to extend good thanks. R.D. Kagra Sahab hai?
Sir, one question here.
Yeah, please.
So in a revenue sharing model, the landlord has to consider as business income or capital gains. Now, say landowner gets 45% share. It is is it to be taken as capital gains or business income?
If landowner is holding that asset as a capital asset,
okay,
then he is chargeable to tax as a capital gain, not as a business income.
Okay.
Bangalore Tribunal judge has very, very good judgment on this part, which I have referred. Again, I can repeat it.
Okay.
This ITA 542 to 544, Bangalore Tribunal.
1 second, sir. Just I'll note down. ITA?
Oblique 542
okay.
to 544.
542 oblique 250.
542 to 544.
Year, sir. Year
of which year?
Which year?
Or 21.
2021. Bangalore Tribunal. Okay, fine.
Okay. और नाम भी लिख लीजिए माथिकारे रमैया.
माथिकारे रमैया. Okay.
Ramaia. This is very, very good judgment of Bangalore Tribunal on this joint development agreement on revenue sharing model.
And one more question, sir. This is the last one.
Yeah.
I just wanted to get a clarification regarding fair market value and stamp duty valuation.
Yeah.
The distinction between fair market value and the stamp duty valuation. Stamp duty. Stamp duty, okay, I understand. It is based on the
fair market value has been determined, has been defined under the definition section, which can fetch the value in the market, open market, if sold in the open market.
Okay.
But wherever it has been substituted by the stamp value, then the stamp value is the fair value.
Okay, that is what, because people generally take into consideration fair market value as the stamp duty.
Because if section so provides that fair value value had to be substituted with the stamp value, then a stamp value has to be taken.
Yeah, because there are so many queries from our clients.
Yeah.
Can you say what's the difference between FMV and stamp duty valuation?
Which?
Thank you.
Sir, as you rightly said, sir, on that whether what is the date of transfer under 45(5)(a), there are two views. Some says only chargeability is postponed to the date of completion, and whereas in the year of agreement there is a transfer. But your view is even the transfer is also postponed, right, sir?
Yes, sir. How it is practicable that chargeability is possible only because in the year when transfer took place, you don't know what is your stamp value of his share, your share. So that is not a practical solution. That is a practical interpretation.
Right.
Any interpretation should be that it should be workable.
Okay. When you are charged on stamp duty value in the first year, you don't know.
No.
Right. Right.
That's why this 5A has been brought in to plug that difficulties only. That in the year of complete certificate, consideration is known, stamp value you know, cost you know, then compute the capital gain and pay the tax.
Right.
It will be transfer only on that year.
Yeah.
It will deem to be transfer in that year.
Yeah.
Sushil ji, my humble suggestion is that if you can make an article mentioning all the case laws which we have kindly mentioned, which we will circulate to our members through various groups.
Okay.
And Gupta ji, due to some problem, phone charging problem, Kakra ji is unable to rejoin, and he has suggested that Advocate Padmanabh Dave from Odisha NEC member, he may be requested to deliver vote of thanks.
Please, Mr. Padmanabh Dave, please.
Is there.
Please, Dave sahab.
Thank you, sir. Pranam, sabko mera pranam.
Welcome.
Respected National President Narayan Jain sahab, Chairman of the today's beautiful webinar, VP Gupta ji, and today's star speaker, CA Sushil Pransukha ji, and past President Ganesh ji, and many dignitaries and many NEC members also I am saying from Odisha, I think Pradosh is also there, on all respected members of the AIFTP. Thank you very much for joining all the delegates, and especially the speaker has taken a lot. In a short, he has tried to cover everything, but the topic is so vast, and as said by our chairman, it is very confusing also. So questions are coming. People have the question, but they are not putting. That is more confusing now because it is not clear. Anyway, the subject is like that, and we have to pound in this and find the solution from case-wise basis. And I think in the next also, a detailed discussion will be there on this real estate issue and how the capital gain or it will be business income, how to go on. It has been seen. And I take this privilege, giving me the opportunity by the President. I thank each one of, and special thank to the Chairman of the session, who has continually, whole of the year, has taken pain, and a lot of virtual meetings, Zoom meetings have been conducted and very beneficial to all the delegates throughout the country. And special thank to the National President and all the office bearers. Thank you, sir, one and all. Wishing some question is coming.
We wish you all our colleagues a very happy New Year.
Yes.
And we wish that late the New Year, if not more, at least double your income.
Yes.
So with this note, We once again thank our speaker and chairman.
Very happy New Year to all, please. So now the meeting will come to an end. Please, thank you very much. Thanks a lot for joining. Thank you, Sushil ji,
Thank
for
you.
taking so much pain.
Yeah.
Thank you very much.
Good day.
Thank you, sir. Happy New Year.